Do you want to be rich, famous, important? Well, options trading has nothing to do with that. Yeah, good luck in all of your endeavors. This ain't how you do it, okay? Anyway, what's good, people? I'm Daniel Omach. Welcome to the freestyle. I'm back. I was gone for a little bit, but I am back. Hope you're doing well. Check it out. Today, we are going to talk about options trading for beginners. I think a few weeks ago, maybe a month ago, there was a lot of hoopla about GME and the stock market was going crazy. I've had a lot of conversations with people that I know, friends of mine, about options trading. Quick disclaimer before we get into things here. Knowledge about options doesn't always translate into making crazy amounts of money in options. So I used to work on a trading floor. I saw hedge funds that threw millions of dollars of expertise at research for options trading. I watched them close up shop. I watched them shut down. So keep it in mind, just because, yes, I have some degree of knowledge about options, I'm really just a guy who learned a bit about options trading because it was an element of my job for a few years. I'm not some sage who is gonna be able to tell you and everybody how to make millions and millions of dollars from options. I would never claim to be, ever, trust me. Okay, let's get into it. So why options, right? People, I believe, are interested in trading options because it has a higher risk reward profile than stock investing. I haven't done a video yet about stock investing, but I may do that in the future. But I wanted to start with the thing that is near and dear to my heart because it's what I used to do. Why is there this higher risk reward profile with options that I talked about? Well, it's because of leverage. It's partially because of leverage, right? So leverage is really being able to make more money by putting less money down. So what are options? You know, how do they work? So options are just the right to buy or sell a stock at a certain price at a certain time in the future. The right. It's not an obligation. You have the option to do it. So we'll start with call options. Let me use a sneaker analogy to describe how call options work. Call options are the right to buy a stock at a certain price at a certain time in the future. So let's say there were some sneakers releasing, there were some Jordan 1s, amazing Jordans that you just knew were gonna be more valuable in the future. Let's say at the time, they are $100, but somebody tells you, maybe Michael Jordan himself tells you, in the future, these will be worth $200 or more. So you're like, okay, I got pretty good information from Michael Jordan, the arguably GOAT, Bron, you know what I'm saying? Probably got to get it. We can talk about that later. And you know, or you believe that these sneakers will be worth $200. Right now they're $100. Somebody says, hey, there's actually an options sneaker market where you can own the right to buy these sneakers in 6 months' time for $120. And you might be sitting there thinking, why would I want the right to buy the sneakers for more than they're worth now? Well, it's because 6 months from now, I think these Jordan 1s are gonna be worth $200, $250, maybe $300. So even though the current value of the Jordans are $100, I want the right to buy them at $120 in 6 months' time. And let's say in this case, you don't even want the sneakers. You just want to make money. You're an investor. So you get a piece of paper that says Jordans, $120, September, right? So, boom, this is what you're buying. You're not actually buying the sneakers. You are buying the contract, the right to buy those Jordan sneakers for $120 on a certain date in September. Then what happens is you're not trying to make money by buying the actual shoe necessarily. In this scenario, you were just an investor who just wants the right to buy it so you can later on sell the right to buy it. So that's generally how call options work. To summarize, call options are just the right to buy a stock at a certain price at a certain time in the future. And it's because you are making an estimation that in the future, that stock will be a lot more than that spot that you have the right to buy it. And by the way, the spot that you have the right to buy it is called a strike price. Terminology is a lot. I'm gonna spend less time on that today. There are a lot of links you can look up. I wanna make sure you understand conceptually how options work. A put option is the opposite of that. It is the right to sell a stock at a certain time in the future for a certain price. So let's say you hear that the price or the value of these Yeezy sneakers are actually going to plummet because you found out that Adidas is going to flood the market with a lot more Adidas Yeezy sneakers, and you want to make money on the bet that the value of the Yeezy sneakers is going to decrease. Then you might buy a put option. And a put option will say, let's say the Yeezy sneakers are currently $200. You heard from Kanye West himself that the Yeezy sneakers are gonna sell for $100 in 6 months, which he would never say. He would probably say like 20K, buy these, but hypothetically. So you buy the right to sell these Yeezy sneakers for $150. And people might be like, why would you want the right to sell these for $150 when currently they can sell for $200? Well, it's because you're anticipating that the actual value of the Yeezys goes much lower than that. So the strike price you decide on is $150. So again, it's about the piece of paper. You're not trying to actually make money necessarily from selling the shoe. In your case, you were trading the option and you want to buy your put option and then sell it. So imagine if the Yeezys are selling 6 months time for $100 and you have the right to sell them for $150, people are gonna be like, I want whatever that dude has in his hand that gives him the right to sell it for $150. That's where the value of an option comes from. And look, it's the same principles to make money on options. Buy low and sell high. I want to interrupt myself and say, like, share, subscribe to the channel. Don't forget. And I also want to shout out my attire right now. Relax Clothing. Relax Clothing. Go to the Instagram page. Check out relaxclothing.us. It is crispy. I think you need it in your life. Check it out. I explain what call options are. I explain what put options are. I explain the general understanding of leverage and how you can make more money from options. So what goes into an option's value? So at a basic level, option value comes from 3 things. Number 1, intrinsic value. Number 2, time value. And number 3, implied volatility. Intrinsic value is just gonna be the difference between the strike price and the stock price. So if a call option is, let's stick with the sneaker analogy, your strike price is $150 for a call option, the right to buy. And the stock is at $200. What do you think your intrinsic value is? We're gonna pause like Dora the Explorer. Cool, it's $50 because that's considered $50 in the money. Your option is $50 in the money, meaning your strike price is $50 less than where the stock is currently trading, also known as spot price. So that's the first element of option value. The second piece is time value. So that's also related to the probability piece that I said before. How much time is left in this option? And the way option markets value that is, if a lot more time is left, then there should be more value in the option. Why? Because there's a chance that that option can get in the money. There's a chance that that option can move in a way that's favorable to the value of the option, of the strike price. So it's almost like the more time you have, the more anything is possible. You can potentially win. It can work out. But As time decreases and decreases, your probability gets lower, particularly if you're not in the money. So let's say, back to the scenario, 150 is your strike price. The stock price is actually at 130, but you only have 3 weeks left. Well, then it's calculating, it's pretty low likelihood that this stock is gonna move $20 up or more within this 3-week period, right? So that's a factor, and that time value contributes as well. And then the last piece is implied volatility, and that just measures the expected volatility of a stock up until the expiration date. And things that add to volatility or implied vol are events, earnings, is Fed Chair Powell gonna speak? Is something else happening? So events and uncertainty drive up implied volatility. Volatility captures fear and uncertainty. So whenever some big thing happens, if we're on the brink of war, if we're part of a trade disagreement and people don't know how it's going to affect a multitude of industries, if COVID hits, which it obviously did last year, that drives up volatility and it drives up the value of a lot of options. There's a lot more to that, but I'll start with that. That's the start. It can be a very complex world. Please let me know if you have any questions. You can comment below. You can reach out to me directly. We're gonna be talking more about investing over the next few months here and there. But yeah, please let me know what you think. Like, share, and subscribe. That's it. Thanks for watching the freestyle. I'm Daniel Omach. I will catch you on the next one. Peace.